All right, Bulls and Bears, BX4 back in the building, back with another dose. Let's go ahead and get right into the economic financial news. Of course, I need to get my second set of eyes on here today as we get into the economic turmoil that continues to unfold. And a lot of people do see the turmoil, a lot of people don't. But if you're living paycheck to paycheck and you think this is good or this is just normal, or if you think you're doing better than maybe your circle of friends or some acquaintances or family, that's not good enough, folks. We need to be, as a society, not so stressed out about every single paycheck. Unfortunately, too many people are in that boat where the paycheck's a day or two late and they're, for lack of a better term, freaking out because they have so many bills to keep up with here. Let's go ahead and get right into the news here. So much to talk about here. The economic engineers, the powers that be, the money printers, the talking heads, the politicians, the bankers out there trying to convince everybody that everything's fine and that inflation ticked down and now we need to cut rates because inflation went down. Well, inflation going down is not a positive thing, especially when prices are still going up. It's just they're not going up as fast as they were. So, it's not as bad as it could have been, but it's still not good. The people that are in debt, barely scraping by, they're just going to have a harder time. And rate cuts are just going to make the problem worse. Look what's happening here recently here. Dollar dives. The 2024 low, gold at record high on hopes of a Fed rate cut. There's people out there rooting for 50 basis points. I think it's going to be 25 basis points, 0.25% on the Fed funds rate. But we'll have to see. I think a bigger rate cut would be more of a warning sign, or at least it should be. That's, in my opinion, that's how it should be perceived. But who knows how the markets are going to perceive this? The markets are the multi-billionaire class for the most part because they own most of the stocks here. Let's go ahead and get into this here. Let's bring up this gold chart here, gold price today. Okay, as I'm recording this early on Friday morning, by the way, Friday, September 13th, we have gold. Bring up a 1-year chart. Look at this, 2,596. I'm sure by the time you watch this, it's going to be off from that. Go out to a 5-year chart. Folks, look at this. Beautiful, isn't it? Beautiful thing. Look at this. Now, I would expect after this recent surge, and maybe it'll surge more on the announcement of a rate cut. Maybe it'll be buy the rumor, sell the fact, and you'll see a pullback in the price. I would expect some sort of pullback here. Same with silver, but I expect a lot further upside here in gold and silver, especially silver. If you've been on this channel, you know that the silver price is really suppressed on the paper market. So what they're doing is big money's out there, whales, shorting the price of silver just using digital platforms, not actually selling the physical item, but using digital platforms. And they can sell it even though they don't have it. There's naked shorting going on, massive price suppression. Naked shorting means they're selling something they don't have with borrowed money to keep the price artificially suppressed. Why would they want to do that? Well, they'd want to keep the price suppressed on the digital platform so they can buy the physical item for much cheaper. And of course, probably most of you know, central banks and corporations and a lot of big money is out there scooping up the physical product, gold, silver, and other metals. And you also have a lot of industrial use for silver. So, of course, they're keeping the price down for that. It's used in weaponry. It's used in electronics, solar panels, so many industrial uses for silver. So the motivation to keep the silver price suppressed is it's much more than suppressing the gold price. So I think we're going to see silver skyrocket, and it's already skyrocketed. I mean, from an investment standpoint, it's already outperformed housing just over the past 5 years. The gain in silver has outperformed the housing market, the price in real estate, right? Pretty amazing. But let's go ahead and move on to a couple other things here. We got a lot to catch up on because I didn't put out a video yesterday. Yesterday was a doozy. I had 5 conference calls with customers, some of them with their family on the line for investment purposes, stuff like that here. But let's go ahead and talk about this. Mortgage rates falling now to the lowest since February 2023. So nearly the lowest in 1.5 years. What do we tell you was going to happen right before November of this year? Keeping those rates suppressed. Now, there could be some big things happening with rates. If we see a simultaneous dumping of the US dollar from all these BRICS nations, that could have an impact on it. And we'd have to really look at how the reaction to that would be. Would the Fed just come in and buy up all the debt? That would be, something that could really make that a nothing burger. But we'll have to see how it plays out. I'd say be prepared for some fireworks, to say the least here. This one caught my eye. Reuters. The IMF supports start of U.S. easing cycle as inflation cools and the economy slows. So at least they're admitting that the economy is slowing. Why is the economy slowing? Well, because consumers are loaded up on debt. And even though they still have credit lines available for the most part, it's only like about 1 in 5 banks are actually tightening right now. So most consumers still have more credit that they can run up, or credit they can use to run up more debt. But people are starting to get concerned on these debt levels, noticing that now close to 50% of people can't pay off their balance in full each month. So now you have this interest that's really stacking up their total balance there. And the interest is accruing and putting these people into record amounts of debt. Again, I think I have to remind people often that record levels of debt amongst the consumers right now. We have the country as a whole, the USA, insolvent, bankrupt. The only way we're still functioning is borrowing more money. And pretty soon it's going to be where we can not even pay the interest on the debt, let alone pay off the principal. But we're going to get to a point here very, very soon in the near future where we can't even make the minimum interest payment on the debt. So there you have another reason for the rate cuts. You see what's going on here? So there's a lot of things happening from a consumer standpoint all the way up to the actual solvency of the U.S. Government. It's absolutely insane. Let's talk about this, though. Recent report here, U.S. Census Bureau, nearly half of renter households are cost burden. And it talks about some other stuff with race, differences in race and stuff like that. Goes right along with the number of people that are not paying off their card in full each month, about half. So it's likely probably the same group here. Over 21 million renter households spent more than 30% of their income on housing costs in 2023, representing nearly half of the 42.5 million renting households in the United States, and they consider themselves rent burden. Now, that was the end of 2023. It's gotten worse since then, right? And you might have noticed the theme on this channel is going to get worse. Well, a few items are actually getting better. Car prices are down year over year. We'll talk about that here in a little bit. Rents down. Housing prices down in quite a number of markets. And we're not going to look at the year over year number. Today, we're going to look at how many housing markets are down from the peak. Because when you look at the year over year number, most markets are still up. But when you look at from the peak, I think you're going to be surprised at how many housing markets and areas are down, right? We're going to talk about that again here in just a little bit here. But let's talk about this. More devastation, and it's going to mean more demand for home building materials. We got Louisiana. Damage. Cleanup after Francine. Francine, the third and strongest hurricane to blast the U.S. so far this year, with 100 plus mile per hour winds. Dangers that'll continue into the weekend here. So, folks, it's not going to stop here. The destruction here, we know that building materials costs have not come down to where they were pre-2020. And that's going to be a continued problem for the cost of building a home, unfortunately. For those of you looking for more affordable housing, you don't want to see this. You don't want to see this inventory get wiped out like this, because that's a factor here. Southern California breaking records for the most earthquakes and aftershocks. Shaken by 4.7 earthquake. I didn't feel it. I'm in San Diego. This one was in Malibu. But we set a record this year. Southern California, where I'm at, we set a record for the most Mag 4 or above earthquakes in a single year. I may have felt one tremor in my neck of the woods here, sort of east of San Diego here. When I first moved out here, I figured, okay, I'll give it a shot. I think my first 5 years, I only felt one tremor, like 20 years ago when I first moved out here. And if it would have been, 5 or 6 tremors per year, I would have probably moved out of California. But I might feel one every 2 years, every 3 years, one minor shake. But, it only happens to have not hit where I am. So I would say a lot of luck involved there. All right, let's move on here, folks. Just wanted to talk about things that can really cause destruction and keep home prices high with the materials remaining high. But here's another sign here that consumers are really not doing as good as we might be told right now. Americans are increasingly worried about missing monthly debt payments. There we go again. Another connect the dots here, folks. Another sign that consumers are struggling. Americans are growing more concerned about missing debt payments and entering delinquency as high prices and interest rates weigh on borrowers. Right? So the boost that the markets will get out of a rate cut is going to be much more than the rate cut's going to help these people that have so much debt, right? A fraction of a percent on the Fed funds rate, it's not going to really matter that much for someone that's not paying off their card in full each month, because you're still 20+% interest rate on the average credit card. New survey data from the Fed showed a decreasing level of confidence amongst consumers in their ability to make just minimum debt payments for loans and credit cards. In August, the perceived probability of missing a payment over the next 3 months was 13.6%. That was the highest reading in over 4 years. So again, for those that think things aren't getting worse, why do we see most consumers saying they're getting further into debt and they're getting further behind and they're more worried about the economy? Yet we look at this consumer confidence report, last week, and the report said consumers are getting more confident, but we see article after article, survey after survey that points just the opposite. People are getting more concerned, more worried as they get further into debt, and the struggles seem to be getting worse for people. Bankruptcies and foreclosures hit 4-year high in California, right? Typically what happens in California goes across the rest of the nation. Now, this last 4 years, we've had some anomalies. We've had some states like Florida and Texas really see massive run-ups in home prices, and home prices are actually coming down now in those states even faster here than California. Remember back in 2008, 2009, bursting of the housing bubble, California kind of led the way, but it was widespread, but some states barely felt the housing bubble. If you lived in Indiana, Michigan, a lot of those Rust Belt states, you really didn't feel it too much. Even Texas back then wasn't wild and crazy like some other housing bubble areas. According to Southern California News Group business columnist Jonathan Hansler, bankruptcies in California hit the highest since 2020. So something else that the levels right now, bankruptcies and foreclosures, are the highest level since 2020. So we're in a pandemic level situation right now with a lot of things here. Citing a quarterly analysis by Fed Bank of New York, examining bill paying habits in several states, including California, 2024 second quarter, 40 personal bankruptcies were being filed and 12 foreclosures were being filed for every 1,000 people. Still a small number, but highest in 4 years. I mean, that should also tell you something might be happening here. We talked about this last report. Ally Bank, huge in auto financing especially, reports unexpected surge in the number of loan delinquencies. My question on this, why would this be unexpected, right? Housing unaffordability, all-time worst levels. Debt levels, all-time highs. Who would think that the number of delinquencies would decrease? It's just going to increase from here, right? Ally Bank, I mean, come on, you got to do better than that. Get a new economist there. Commercial property and bank loan delinquencies, the highest in 11 years, folks. Keeps piling in. The data keeps piling in. Multifamily rates spike in second quarter, spotlighting supply outpacing demand. Commercial property bank loan delinquencies reach highest level in 11 years. So those losses on the books of the banks that are over $500 billion, commercial real estate losses, Just going to get deeper underwater is what it looks like here. So it's going to have to be record-breaking bailouts here to keep the banks going here. Let's talk about the housing bubble next here and get into some charts here. And this is out of Wolf Street here. We're going to look at Austin, Texas. First, we just talked about how Texas was massive run-up, huge run-up, right? I'm going to bring up a bigger chart here for all of you here. Look at this. Let's go back to the housing bubble 1.0, if we want to call it that, right? Just over 200,000, maybe 220,000 at the peak. And then the bust was going from 220,000 down to, looks like about maybe 170, 175, right? Minor bust compared to what's going on now. Look at this, folks. Price dropped down to 175 about 2011-12. That was about the low. Folks, peaked out here in 2022 at over 550,000. Looks like about 560,000 median home price. Folks, look where we're at, down from the peak here. We're at right around 450,000, over $100,000 off the median home price there in Austin, Texas. Wow. Wouldn't want to be someone buying at the peak there in Austin. Let's bring up a couple other charts here, some interesting ones here. Look at Phoenix. Wow, this is interesting. Still out of Wolf Street here. Housing bubble 1.0, just over 300,000 at the peak. Spiked nearly 500,000. Dropped down. Try to go back up again with all the down payment assistance programs, with all the easy money loans out there still. And just over 450,000. So pretty big price shave there off from the peak. And again, if you look at the year-over-year numbers, it's not quite this drastic here. But looking at it from the peak, I think is much more interesting. We've got Portland, similar to Phoenix. Get another one here, Seattle. Here's a good one. Seattle peaked out about 700 and I'd say about 770 there, 770,000. Dipped back down, trying to go back up again. Look at this. So we're still down heavily from the peak, but at one point it got down here in late 2022, got down to about 675,000, which is down from the peak, which is about 770,000. So pretty big price volatility there over the past few years in Seattle. Back to what we talked about at the beginning, the dollar dropping, gold at record highs, near record highs. The dollar at a 2024 year low. People often ask me, the dollar is still strong. Why? Well, ask yourself, is it really strong? When you say the dollar is at a 2024 low, that's just the tip of the iceberg. Remember, the dollar is being compared to other currencies that are also fiat currencies. And people ask me about this. Fiat currency just means you can create it out of nothing. A bank can issue a loan with money they don't have. They don't have to have it. There's no gold backing this. There's no limits. So banks, including your Bank of America, Chase Bank, banks that just give out loans, can loan out money that's actually non-existent, meaning they can create money in digital form. And the same thing with the money we borrow as a country from the central bank. It's fiat, folks. So that's what we say when the dollar looks strong, even though it's at a 2024 low. Even that's not the full story. The dollar's only strong compared to other fiat currencies. It's a basket of other fiat currencies. But ask yourself, is the dollar strong when you look at what it can purchase? The purchasing power of the dollar, inflation, right? All this money creation has consequences. Yes, it can help cover up an economic collapse. It can help give the illusion that the consumer is strong and resilient, right? Even though people are in record amounts of debt, it can still give that illusion, because if you can keep on pumping money out there, giving out loans, all the above, it's going to make the economy look like it's doing still pretty well, when really it's a debt binge or lending and spending driven economic growth illusion is what I like to call it. So there's a reason, folks, why gold skyrocketing, and even the other fiat currencies that we're comparing the dollar against, now we're at a 2024 low. So definitely some things to keep an eye on here. Let's talk about this. This is car repossessions. We definitely see an uptick in repossessions. Man hit with terrorism charges, accused of creating bomb hoax to avoid car repossession. So what this person did and I'll sum up the article for you. He attached propane tanks to his car and put wires onto them to make it look like they were rigged, right, to explode. And of course, the repossession tow truck driver, the repo guy, called the cops. So not only did he still end up getting his car repossessed because they came out and they figured they looked at it and they said, okay, these wires really aren't connected to anything that's going to make this thing go off. So it was a kind of a fake thing. But the fact that he made the threat or put it out there, put the fear out there that this thing might blow up, he now has these charges against him, and he still ended up getting his car repossessed. So that's just one example of, I'm sure, probably millions of insane things happening right now with people getting their cars repossessed, couples having trouble in their relationship, marriages falling apart because of debt, people arguing about money. Right, million stories I'm sure there's out there. And some of you probably have some stories you could share too on this whole financial situation. What are people doing to avoid their car getting repossessed? Yeah, I've heard of people hiding their car at friends' garages so it doesn't get repossessed, parking their car not in their own driveway so the repo man can't find it, parking it around the corner or some other maybe friend, relative, neighbor's house, who knows. A lot of things happening right now, folks. The debt levels are not sustainable. Things are falling apart. You just have to look at the right areas to figure out, where it's falling apart. And there's a lot of things happening right now. A lot of threats on the horizon, I think right on the doorstep here with what we've got coming in the next couple months with the BRICS announcements coming up in October. Bank reform coming up in October, supposed to be October 1st. We'll see if that sticks. Folks, we could be weeks away from some massive, massive fireworks. Keep an eye on this channel. Please make sure you subscribe. Very important time to keep ahead of the financial curve. And we're going to keep stacking here, folks. We're going to wrap it up today. Make sure you subscribe. Please give us a like button. Get this video a little bit of traction. And we'll see you on the next report. Bye for now, everybody. Peace.